So, the latest numbers from real estate giant Douglas Elliman are out for 2025. And wow, at first glance, they look like a blockbuster success. I mean, after a year of some pretty tough losses, they've suddenly posted this massive profit. So, the big question is, how did they pull it off? We're about to dig into their pretty impressive fourth quarter to find out what's really driving this turnaround.
And, the company's CEO, Michael Liebowitz, he is not holding back. On their recent earnings call, he called it a period of bold execution. Now, that's a really strong, confident statement, right? It frames this whole comeback as a master plan, a strategic victory that was carefully planned all along.
And yeah, that really is the million-dollar question here, isn't it? How does a company in such a crazy competitive market stage a comeback that's this dramatic, this fast? Is it just brilliant strategy, perfect timing, or is there something else going on? Let's find out. All right, so let's get into the company's official story. They're crediting this success to what they call a strategic transformation. The CEO specifically pointed to 4 big moves they made in the fourth quarter that he says were absolutely central to their game plan. So, what did they actually do? Well, first, they pushed hard on growth, setting up new teams to expand both here at home and internationally. Second, they branched out into new services with their Elliman Capital mortgage platform. Third, they brought in some fresh blood at the top, hiring new C-suite leaders. And finally, they invested in new tech and data tools to give their agents a real edge. You look at that list, and it's a pretty aggressive all-around strategy. Okay, so that was the plan. But did this whole 4-part strategy actually work? Well, if you just look at the big headline numbers, the answer seems to be a huge, resounding yes. For the full year, their revenue climbed to just over $1 billion. That's a pretty solid 3.8% increase from the year before. It's not, setting the world on fire, but it's that steady, positive growth from your core business that you really want to see. But here's where things get really wild. The real headline grabber is that fourth quarter profit. The shift is just staggering. In the fourth quarter of 2024, they were in the red with a $6 million loss. Fast forward just 1 year, they're looking at a $68.6 million profit. I mean, that is an absolutely massive swing. But a turnaround that dramatic, it kind of makes you want to lift the hood and see what's really going on, right? And when you do, you find one very large, very important number that puts a big asterisk on the whole story, and it changes the entire narrative. So you have to ask, right? If the core business revenue only grew a little bit, how on earth did the company's bottom line just explode from a loss into a nearly $70 million profit in a single quarter? Was it really all because of those 4 strategic moves? And here it is. This is the number that just unlocks the whole thing. $81.7 million. And the key part? According to the company's own report, this massive gain wasn't from their normal operations. It was a one-time thing. So it turns out this huge pile of cash didn't come from selling more luxury penthouses or expanding their mortgage business. It came from selling off an entire division of the company. Now, why would they do that? Well, companies do this all the time, right? Maybe to double down on their core business, pay off some debt, or maybe they just got an offer they couldn't refuse. It's a smart financial move, but it's not the same as recurring income from your day-to-day business. So to really understand what's going on, we need to compare apples to apples. And to their credit, Douglas Elliman actually helps us do that. So let's see what the financial picture looks like when we take out that one-time sale and just look at the core business performance. We do this by looking at something called adjusted net income. It sounds kind of technical, but it's a super simple idea. You basically just take out any weird one-off events, like, say, selling off a whole chunk of your company, to get a much clearer picture of how the actual day-to-day operations are doing. And look at this. The difference is just stark. That reported Q4 profit of almost $69 million, poof, it turns into an adjusted loss of $14.2 million. And that full year profit of $15 million, that becomes an adjusted loss of $27 million. So that big sale didn't just boost profits, it pretty much single-handedly created them. But hold on, there's another important wrinkle here. Even though they had an adjusted net loss for the year, there's another way to look at operational health. And on that basis, the company's adjusted loss was only $14 million for 2025. Now that's a huge improvement over the $24 million loss from the year before. So this suggests that, yeah, the core business is still losing money, but it's actually getting healthier. So where does all this leave us? Well, when you put all the pieces of the puzzle together, you end up with 2 completely different, competing stories about Douglas Elliman's performance. On one side, you've got the official story, a triumphant return to profitability, all powered by bold execution. On the other side, you've got the adjusted reality, an underlying operational loss that was basically covered up by a really well-timed asset sale. But it's also a reality where that operational loss seems to be shrinking, maybe because of those 4 strategic moves we talked about earlier. And this brings us to the final crucial question for anyone trying to figure out how healthy a company really is. What's a better crystal ball for the future? Is it the massive, flashy, one-time gain that grabs all the headlines? Or is it the slow, steady improvement of the core business happening underneath? That's the real story for investors and analysts to figure out.